So let gold go to maybe $4,000 an ounce, which it could easily do in the not too distant future with the way the world is, and let the gold to silver ratio go down to, 40, 50, something like that, where it's been multiple times in history. And then boom, $100 silver, so it's very easy mathematically.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for March 4th through March 11th, 2024, while supplies last. First, we feature backdated 1-ounce silver maples at $3.39 over spot. We also have circulated British gold Queen Elizabeth sovereigns at $26.99 over melt. And finally, we're offering our choice 1-ounce Palladium bars at just $119 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend John Rubino from rubino.substack.com. John, thank you so much for joining us today.
Hey, Elijah, great to talk to you again.
Well, it's great to have you, especially during these exciting times. We're seeing quite a move in gold, hitting all-time highs here above 2,100. We're recording this on Wednesday, but it seems like there are some fundamental things happening and shifts going on. I know our friend Doomberg on Substack as well has been commenting on this, saying that there's arbitrage going on in Shanghai, possibly, that is pushing the gold price higher. What is your perspective on why gold is rising so much lately?
Well, there are 5 or 6 reasons that could explain what's happening. And they all fall into the category of, well, eventually that was going to happen, and gold would go higher. But what Doomberg is talking about is an especially interesting one. Now, the basic story is that a few years ago, China set up a physical gold exchange in Shanghai. And that led some people at the time to start speculating that, maybe physical was finally going to become the price driver rather than the paper games that are played in the West with gold and silver. And it could be that that's starting to happen right now because gold is trading at a premium in Shanghai to the London futures contract price, which means there's an arbitrage. You can buy gold in London, sell it in Shanghai, and pocket the difference. And that's leading a lot of physical gold to move east. Exports of gold out of London and out of Switzerland are at record levels right now. Most of it's going to China and to an extent Russia and India. So what's happening now is that at long last, the migration of gold from west to east is actually starting to have an effect on the price, maybe. And if physical begins to actually set the price, in other words, that's the dominant price that we look at rather than whatever's going on in the futures markets, and it's probably going to be a higher price going forward than we've seen in the past, because if you're buying physical, you're not really trying to manipulate gold lower, right? Whereas if you're playing games in the futures markets, yeah, frequently it's in your interest to make the price go down. So we'll see. That's a possible explanation for what's happening right now, among many other explanations. But it's, I think, in general, a very positive thing for the gold market.
Now, as for where we go from here, it seems like we've really broken out of resistance. There's not really any resistance above, and we've been consolidating for a couple of years, really, since the COVID era in this, 1600 to 2000 area. So it doesn't seem like it's just been going straight up for years. So it seems like it might be time for quite a bit of a rally from here. Your perspective on do gold prices just continue to rise in the coming months?
Well, the whole is 2000 resistance or support question has been interesting for quite a while, because we've been in a trading range for, like you said, several years, where gold will get up to 2000 and then get smacked back down. So it was resistance there. And finally, gold broke through. And then the question was, well, would 2000 be the floor from now on, which would be great, because especially if you, for instance, own a lot of gold mining stocks, the gold miners benefit from the perception that gold is going to stay above 2000, because then you can build in really robust cash flow projections for them and everything, because they're getting a lot for the gold that they're selling. And that thesis is looking better and better lately because gold is now, like you said, it's up above 2,100. So that means 2,000 is looking more and more like a legit floor for gold. So even if it gets knocked back down right now, there's going to be a lot of buying coming in at 2,000, and then gold will go back up. That's from a technical standpoint a really positive thing too. So yeah, there are a lot of things happening that point towards higher gold in the future. And the biggest and most long-term one, of course, is that we're destroying the global financial system. And if you look at what the U.S. is doing, for instance, we had double-digit inflation in 2022. And since then, we've had kind of high interest rates, but then the government took over with massive deficit spending to keep interest rates from blowing up the economy. And so recently, we've been adding $1 trillion of debt every 100 days in the US, which is basically a kind of a death spiral statistic. When you're borrowing that kind of money and that kind of a time frame, that means you're headed towards that financial cliff at an accelerating rate. And that's very good for gold too. So, there's no way to know why it's up right now, other than to say that there's lots of good reasons for it to be up and lots of good reasons for it to keep on going up. Because really, um, 2,100 is not any kind of a destination point for gold. Most of the guys who've run the numbers where they look at what gold price would be necessary to back the world's fiat currencies at a 40% ratio, they get humongous numbers. They get $10,000, $15,000 an ounce. And since we're heading for that kind of a currency reset, there is no reason to think that 2,200 or 2,500 or whatever is any kind of a terminal point. That's just a way station. There'll be fluctuations along the way, but gold is going to go much, much higher from here over time based on the horrendous mistakes that we're making in the US and around the world.
And mentioning the debt crisis and how we're adding in the US $1 trillion to the debt every 100 days now. What reason do you have to think? Because the critic of that might say, well, people have been talking about the U.S. national debt for decades and saying it's out of control. So why is it at this stage that it really is unsustainable from this point going forward?
Well, the numbers just keep on getting bigger and bigger. And at some point, you reach an area where the math just doesn't work anymore. And I think you can make the case that we're kind of there now, finally, at long last. Because what's happened is inflation led the Fed to raise interest rates, which caused the debt costs on the U.S. national debt there were the interest costs on that debt to spike. So we're up around $1 trillion a year, just interest on the U.S. national debt. But now that we're borrowing so much more money in order to keep the economy going, we're running these big deficits. All of that has an interest cost too. So in this year, in 2024, we're scheduled to issue $10 trillion of treasury paper. Now, 1.5 trillion of that is the deficit, which is borrowed money that we're going to have to pay interest on going forward. And the other 8.5 trillion is already existing debt that has to be rolled over at higher interest rates. So all this new debt being rolled over and taken on new at higher interest rates means the government's interest cost is going to spike again from here. So in the not too distant future, we're going to be at 1.5 trillion a year in interest, all of which has to be borrowed and then interest has to be paid on that. So as it accelerates, you get closer and closer to the point where it just doesn't work anymore. So, are we right at that point? There's no way to know. Just like there was no way to know whether 5 years ago we were at the end point and things were going to break down. Well, what we can say with certainty now is that we're closer to that point, and wherever that point is out there that just blows up the financial system, we're heading for it at an accelerating rate. So yeah, debt did not destroy us in the past 30 years, even though it looked like it might at different times. But it's going to, it's going to cause the financial system to break down somewhere, somehow. And these current numbers, my God, 100 or $1 trillion every 100 days and $1.5 trillion in interest expense and $10 trillion of debt being rolled over. Those are all death spiral numbers. So I wouldn't think that it can go on much longer than this because already, with $1.5 trillion of interest expense, the government takes in about $4 trillion a year in tax revenue. Well, if we're getting up towards interest expense accounting for half of annual tax revenue, that there's a death spiral number. That's one where you just can't maintain that kind of a pace for very much longer. So I think we reached the point where things start blowing up, like the banking sector, for instance. The federal government has to step in and bail them out. And that leads to anxiety about what that does to the currency. And then things spin out of control. We get another year like 2022 when inflation spikes to double digit levels almost, or in real terms, double digit and almost double digit in, in official terms. And that leads people to look at the effect on the dollar, and the dollar starts to fall against real stuff, not against other currencies. Don't look at the dollar index or anything, because all that is um, measuring the dollar against other currencies that are being destroyed by, in some cases, even faster rates. So against real stuff, which is to say inflation spikes again. So all that's out there waiting to happen. The numbers point towards it being, if not immediately imminent, coming fairly soon. So things get very interesting very fast at some point.
And mentioning the banking system, it seems like we're seeing trouble with New York Community Bank, and also the Bank Term Funding Program, which was the lifeline given to the banks by the Federal Reserve during the banking crisis last year, is coming to an end in just a week or so. So your perspective on the current state of the banking system?
Well, yeah, the US banking sector, especially the local and regional banks, have several big problems, but the biggest one is commercial real estate. It's as part of their business model, they lend money to local builders. So there's a huge amount of paper on their books relating to office buildings and apartment complexes and warehouses. And a lot of that paper is going bad. For instance, with office buildings, um, over the past 10 years, a huge amount of office space went up, financed at really low interest rates. Then the pandemic hit, and a lot of people found out they like working from home, and fewer people, or not everyone, has gone back to work in office buildings. And so the occupancy rate is low in a lot of big buildings, which makes them not as valuable as they were, and they're not generating enough cash flow to necessarily pay off the related debt. And in any event, that debt's coming due at higher interest rates, which make those buildings worth even less. So a lot of office buildings are going to start changing hands, or they are starting to change hands at lower prices, which means there are embedded losses somewhere out there as those buildings get sold at big losses. A lot of that is on the balance sheets of these local and regional banks. So they're going to have to take those losses at some point, and that's going to blow a lot of them up. So the one you mentioned, New York Community Bank, is in the process of maybe blowing up right now. So that might be one that starts a kind of a tidal wave of bank implosions as everybody looks around for what's next. And then whoever they think is next, they pull their deposits out, which causes those banks to have to sell some of their depreciated assets in order to pay off their depositors, which means they have to take those losses publicly and so on. And I think we get to a point, very possibly, where another big banking crisis happens and the government has to step in and bail them out. So that's another $2 or $3 trillion on top of what we just talked about with government finances. And that might be the thing that shifts the focus away from banks or office buildings or whatever and towards the currency, because the bailout is going to be so big on top of all the other borrowing that the government's doing that makes everybody worry about the dollar. So that's when things change. And it could be that this is what makes it change. And if not, there's all kinds of other catalysts out there. There's so much stuff that could go wrong because so much bad debt has been taken on lately that there's no real way to know what the first domino to fall is. But you know that once one falls, the rest are in danger. And that's basically the story of the next few years for us, which is the catalyst that's going to blow things up. And And we'll see. But I think right now the leading candidate is local and regional U.S. banks.
One of the other catalysts that could cause some unrest to happen is the political situation right now as we head into the election. Your take on that as we look into the election to November, is that, do you think, going to cause any unrest or have any impact financially?
Yeah, we're heading into a really contentious election where both sides expects the other side to steal the election. So whoever it is that wins this time around, unless it's just a total landslide, see, that would be the thing that saves us if there's a landslide. So there's no way the other side can argue about it. That's highly unlikely. So more than likely, it's going to be a tight election. The losing side is going to believe that the election was stolen, and then you get all the unrest that flows from the perception of a stolen election. And I think that one of the reasons for that is that we're just a very divided country right now. Neither side trusts the other side. We both believe that the guys on the other side are willing to lie, cheat, and steal to get what they want. And the other thing is that we've set up an awful lot of electoral systems in U.S. states almost as if we want to be seen cheating because you've got these voting machines out there that can be hacked. Everybody agrees they can be hacked, and they have no paper trail. They're just electronic tabulation machines. So you really can't tell what happened. You just see the number there. So that's one thing that makes the system really untrustworthy. And then a lot of other states have gone to basically mass mail-in balloting where you never actually see the person who's voting. You never check their ID. You never prove it's them. You just get something in the mail that has a signature on it, and then you check the signature. And if it's anywhere near the signature you have on file, then you count the ballot. And so we already saw a lot of cheating going on in the last couple of elections using the mail-in ballot system. And it hasn't really changed. There's still mail-in balloting out there in a lot of states, including mine in Washington State. So we're leaving the door open to mass election fraud. And because of that, whoever loses a close election is going to assume that they got cheated. And that's a really bad recipe for a political system that really needs to be stable because the financial system is unstable. But if you've got a political system where people are in the streets, rioting over elections, and the National Guard is being called out, and people are being labeled insurrectionists and things like that, then that feeds back into the dollar and interest rates and the banking system. Because if we don't trust our political system, by definition, we can't really trust the financial system because the politicians are running the financial system. So yeah, it's completely possible that finance feeds into electoral politics, which feeds back into finance in a kind of a self-reinforcing feedback loop that gives us chaos. And we got to hope that that's not the case, but we're kind of creating the conditions in which it could be the case. So yeah, wherever you look, there are reasons for anxiety.
Well, it seems like a perfect storm for precious metals, and I guess that might be some of the reasons, obviously, as we've gone over, why gold is hitting all-time highs now. As for silver, I know silver is both a monetary metal and also an industrial metal. And recently wrote an article about, or a series of articles about, how do we get to $100 silver? And that's really not, it doesn't seem like out of the question. If you do an inflation adjusted price of what we had in 1980, it would be over $100. So it seems really in range. A couple of the bullish factors there that aren't necessarily even monetary related would be the solar demand for silver and also a stagnant mine supply. Can you go over some of the bullish fundamentals for silver that you see that really don't even have to do with, a break-in economy or a unstable political system?
Yeah, $100 silver, the math is very easy to get there, which is part of why I think we see that in the not too distant future. But one way you get there is by having a shortage or, a deficit turned into a shortage where you just can't get the silver that you need, so you've got to pay up for it. And solar power is playing a role in that process because that's a fairly new use for silver. 5 years ago, solar was not really a big factor in the silver market, but now it's up to about 1/12 of the silver that is taken out of mines each year. So that's a big new factor in what was already a tight market. The silver market is already in deficit. In other words, between industrial uses and investment demand, more silver is being demanded each year than comes out of the world's mines, and that comes from recycling. So we're already running through excess silver stocks that are sitting above ground right now, and those are going to be gone pretty soon. So if you get silver demand or silver demand from solar going up, which it looks like it's going to, because the next generation of solar panels use more silver per panel than the existing generation, and demand for those next generation panels is spiking. It looks like it's going to grow dramatically over the next 5 years. So you get rising demand for silver from solar and other industrial uses and military uses, which are kind of black box. We don't know what that is, but we know it's a big number. And from investors who are more aggressively than in the past buying silver, then you run out of silver, and if that happens, the price spikes. That's just how commodities markets works. And we've seen that happen in a lot of other commodities over the last few years where there's a shortage, artificial or organic, and the price of the commodity just spikes. So with silver, that's easy to envision, and you don't really get you don't really get demand destruction at slightly higher silver prices. In other words, solar panel manufacturers won't stop using silver until it gets up into the $50 to $100 range. And even then, that'll happen with a big lag, right? You don't just convert your production processes on a dime like that. So silver could get tighter for industrial reasons, and that could lead to the price going up. And then, with gold going up, you can also just look at the gold silver ratio because that's it's not stable. It's got a really wide range, but it does operate within that range. In other words, if gold gets too expensive, people start buying silver as the next best thing because it's relatively cheap. Well, we're in that kind of range again. I think the gold silver ratio is something like 85 right now, right? Maybe even 90. And that's usually the point at which silver starts going up faster than gold. So if you've got gold going up and silver rising faster than gold, it's not very hard to get to the point where the gold silver ratio is down to 40, where it's been multiple times historically. So let gold go to maybe $4,000 an ounce, which it could easily do in the not too distant future with the way the world is, and let the gold to silver ratio go down to 40, 50, something like that, where it's been multiple times in history. And then boom, $100 silver. So it's very easy mathematically to watch silver do these things and get us to $100 silver. And I think even if silver doesn't quite get to 100, we're still going to look at the silver price of 4 or 5 years from now and think, man, I should have loaded up at the 2004 price. And so I think this is a good time to be adding to silver, especially physical silver, where the premiums are not crazy. So you can buy good quality silver coins for $3, $4, $5 over spot, which you guys offer every once in a while as part of your sales. I think that's a good thing to be doing now.
If our viewers are interested in learning more, John, and following your work, they can go to rubino.substack.com. Can you share with us a bit what you published there?
Yeah, it's rubino.substack.com. Like you said, it's a newsletter that focuses on or kind of almost takes for granted a lot of the gloom and doomy stuff out there now. We're assuming that the world is heading to a very complex, very tempestuous place. And what do we do about it? So it's about how you prepare yourself, via actionable advice to be ready for a world with higher inflation, financial instability, political instability, and possibly workforce instability. What all do you do? So, so far, so good. It's a 1-year-old newsletter, and the community that's kind of coalescing around it is turning out to be really interesting.
Fantastic. Any last thoughts before we let you go, John?
Yeah, the gloom and doomy part of this story, which is compelling and interesting to talk about and everything, can also be really depressing. So I think it's psychologically important to treat it as an investment thesis. In other words, what do I do with my money in order to not just protect myself, but maybe get richer as all this stuff plays out? And that, first of all, it's a very possible thing. In crises, there are big opportunities, and a handful of people who get it right tend to get very rich. So we can be among those people if we do this right. And it's much easier to get through the day when you're thinking about how much money you're going to make than if you're thinking about the horrible things that might happen in the banking system or politically or whatever. So focus on the good side of this, which is the investment thesis, and you'll be a lot happier person.
Right. And I think another thing we can focus on is really growing ourselves as individuals and growing our skills and becoming working more local and with growing our community. And those are all great things. And I think those will all come in handy as well if we do see a system collapse. So, John, we really appreciate your time today. And thank you so much, and God bless.
Thanks, Elijah. Take care.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for March 4th through March 11th, 2024 while supplies last. First, we feature backdated 1-ounce silver maples at $3.39 over spot. We also have circulated British gold Queen Elizabeth sovereigns at $26.99 over melt. And finally, we're offering our choice 1-ounce Palladium bars at just $119 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.